different way. Time and effort is such a shit.
What's up, everybody? Welcome back to my channel. This is Pat Burke and you're watching Icon Trade. As you guys can see by the title above, the focus on today is going over penny stocks. What exactly are penny stocks? A lot of people underplay penny stocks. A lot of people overplay penny stocks. So I'm just gonna throw the facts at you guys. And I'm gonna let you guys make your own educated decision. What exactly are penny stocks? Well, the SEC defines penny stock as anything under $5 or less. Another rule of thumb that people use is anything under $2. Now, penny stocks can either be listed on a major exchange, which is the New York Stock Exchange or NASDAQ, or they could be over the counter or on the pink sheets markets. If a stock is listed on the New York Stock Exchange or the NASDAQ exchange, they have to comply to financial filings. For example, they have to accurately report their financial statements, and there's a lot of rules and regulation. Also, to be listed on these exchanges, they have to be over $1. Now, if you're looking at stocks that are on the OTC BBB market or the pink sheets market, which are over-the-counter types of exchanges, these financial regulations aren't as strict and don't really exist as much as if they had to be on the New York Stock Exchange or the NASDAQ exchange. Now, for that reason, there's a lot of manipulation and false information out there.
Now let me tell you about this pink sheet I just came across. Arrow Time, brand new facility, loads of funding. You're gonna say, Patrick, I wish you told me sooner.
So like looking at the over-the-counter exchanges, you could see that there's a lot of risk that could happen because they don't have to be completely truthful on these exchanges or release quarterly filings, for example. That's one thing they don't have to do. So there's a lot of risk on looking at an over-the-counter exchange for penny stocks. Something else that is generally regarded with penny stocks is they're gonna be small cap stocks. Their market capitalization for a small cap, which means that their market value on the exchange is 2 billion to 300 million, in between that range. Now, once you go under 300 million, you become a micro cap stock, and micro cap is 300 million to 50 million. Once you hit under 50 million, it's a nano cap stock. Now, primarily when you see all these big day trades for stocks that go up 100, 200, 500% one day, and they're penny stocks, these are gonna fall into the nano and micro cap range. Now, there can be large cap penny stocks. For example, if you look at Ford right now, Ford is right now a large cap of $10 billion in market capitalization. However, it's trading on sub $5, and under the SEC, under $5 is considered a penny stock. Now, Ford is an example of a stock that will not make a crazy move like the other penny stocks we are going to talk about. And I'll go over the reasons for this. A quick little forward on this is that Ford's float is way too high to have these significant moves. It's also way too liquid, but we'll go over that more in detail later on in the video. Now, an example of an over-the-counter or pink sheet stock that clearly was manipulated. Let's take Arrow Time Dynamic from The Wolf of Wall Street. He clearly says, and this movie is based on somewhat real events of Jordan Belfort, the real Jordan Belfort. They were pumping this thing up and then they were selling it. And that's gonna bring us to our first thing of penny stocks, the pump and dump, one of the biggest schemes of penny stocks. Now, there's a couple different types of schemes, but pump and dump is probably the most famous, and it is very illegal. However, it happens all the time. Asking, why would people at all invest in these penny stocks? Well, penny stocks are usually tech startups, right? They're just starting, or biotech startups that they haven't been proved to be successful, or it's a really high risk business venture. And a lot of people, the majority of the people think that they're going to fail. They have a small chance of succeeding. However, sometimes these do succeed. And when they do succeed, they have very, very big returns with them. But I'm gonna state right now that these are very improbable situations. So if you think you could just go invest into a penny stock and then in 10 years from now, it's just gonna blow up and be worth $300 per share where you bought it at 10 cents. There's probably a less than a 10 basis point chance of that happening. But I mean, it does happen. Some people get wealthy beyond their wildest dreams off these. Is it complete luck? I don't know. Sometimes if you really know the business, you really believe in the business, you could invest in these long term. I just wouldn't recommend putting your life savings. Or the fun with these penny stocks, these really small micro cap and nano cap stocks comes is day trading them, because you could see crazy returns in single days with these stocks. One thing I want to point out, these crazy returns are usually very, very short-lived. Now, you can see by the chart I'm posting right now, this company surged over 100% one day, but then next week, right back down to where it started. So now, one thing to know about these things is they're really high risk investments, and there is a lot of manipulation and fraud going into these penny stocks that you have to be very careful for. Because one thing to note, you're playing in a ballpark full of primarily active traders, right? Day traders, retail traders. You're not really playing with institutions. It's really hard for institutions to get into micro and nano cap stock. One reason is because it's just not worth their time and effort. There's a lot of rules and regulations for them to even be able to get into them. So when they're making, a large institution is making a purchase, they're making a large purchase, right? A large equity stake. Now if the micro cap of a company is 50 million, it's going to be very hard for a large institution to get in. Let's say they want to get in with $5 million. That's not even talking about their insiders holding and their beneficial owners already. It's going to be very hard for them to get into it without moving the stock dramatically. So for this reason, it's very hard for institutional people to get into these stocks. So it's primarily ridden by day traders. When it's through day traders, this is a zero-sum game, and you gotta understand it's actually a negative-sum game because there's fees and commissions you have to pay. That means for you to make money, somebody else has to lose money. And that being said, if it's primarily run by day traders, you can't be doing what everybody else is doing if you want to make money. You gotta be contrarian. You gotta be doing what the other 90% is not doing. You gotta go against them. And that's how you're gonna make money off of them. That being said, this is a very hard playground to play in. Now, I wouldn't recommend any beginners, even though it's, aimed at beginners because it's very low capital to get into. I would not have any beginners start trading penny stocks. This is a very hard market, and you're gonna go against a lot of pros. Obviously, these pros want beginners to go in because they're just gonna take their money from them. Okay, so let's go into factors of what actually makes these stocks move. Now, the first factor we're gonna take is flow. Now, let's just say company XYB has 100 million shares outstanding. Now, out of that 100 million shares, 80% of those shares is held by insiders or beneficial owners. That means they have rules and regulations determining they can't sell. They can only sell at certain times, right? And they have to make it publicly. When we're talking about exchange traded stocks like the NASDAQ or New York Stock Exchange. Now, that 20% remaining is known as the float. That's the tradable amount of shares. Now, when the float is low, especially compared to its shares outstanding, it's very easy for the stock to move because that really concentrates the amount of shares that can be traded. It makes the stock more liquid. Because of that, when the spread opens up, the stock kind of skips prices. So it could go up really fast or it could go down really fast. Now, going on to our next thing, we have high short interest. So a lot of these penny stocks are really high risk companies that probably aren't going to succeed. So a lot of people are shorting these companies. And when they short the company, right, let's just say the company has a 90% short interest. That means 90% of the shares outstanding or the float is going to be short. People are betting on it to go down. Now, let's just say the stock gets very positive news and the sentiment goes from it's going to fail to it's going to succeed. The only way for those shorts to get out of their positions is to buy back the shares that they lent out. Now, when they buy back the shares, that's obviously going to drive the price back up. So this is something called a short squeeze. And what a short squeeze is when there's positive news or the stock's running up, right? And then all the shorts that are stuck in the stock buy back their shares, and that makes the share price go up dramatically because you have 90% of the people who are holding the stock going to buy to get back to their positions. And that's just gonna drive up the price. Plus, then you're gonna get just momentum traders who are looking at this crazy move up and like, oh, I want to get into it. So then the buying sentiment is going to be very, very high. Another factor that makes it go up is a news catalyst. So let's just say like we have a biotech company, for example. The sentiment on it is that it's going to fail. However, they just got positive testing for their drug. Now the company price is surging and stock is just going to go up, right? It could go up over 100% in a day because the drug was successful when it was thought to be. The general consensus was thought that it was going to be negative. And that being said, a lot of these small cap, micro cap, and nano cap, especially when they're not traded on the exchange, can have a lot of false misrepresentation on news catalysts. They could either pull old data or old news and then try to revamp it as new news, which it's not. They could also do a reverse split. And what a reverse split is let's just say they do a 5-to-1 reverse split. That means for every 5 shares you have, you now get 1 share. But the price also goes up 5 times. So it might look like the stock went up 500%. And why they do this sometimes is to let people see that the stock went up 500%. So now it's on everybody's radar. They're like looking to trade the stock when it really was just a reverse split. Nothing's changed, just a reverse split. And this sometimes can work. I've been talking about upside, now I want to talk about downside. One of the worst things possible that can happen for these stocks, especially if they're a very low float stock, is an offering. What an offering is, it's bad for any company, large cap, no matter what kind of company, but it's really bad for these small caps, especially if they're going off low float. Now what an offering is that the company is offering more shares available to the public. So it's kind of like an IPO, but it's another IPO. So IPO, you offer this many shares to the public. Now you're offering more shares to the public. So that's an offering, and that really kills the price. Go over who should be playing penny stocks. Now, you should be playing penny stocks if you are a very skillful trader. And I really recommend using OCO brackets when trading them, especially if you're a little bit newer. If you're more advanced, you probably don't want to use OCO brackets. You could, but if you're newer, you definitely want to use OCO brackets. And what OCO bracket is it just has, once you buy a stock, it automatically attaches a stop loss and a profit target. That way, if there's a quick move, like which happens many times in these, you'll be able to get your orders in and out. Even though you might get some bad slippage on them, you'll still be able to get your orders in. Recommendation that I would do is I would not invest a lot of capital. If you were going to invest for long term, don't pick one and invest a lot of capital unless you are absolutely sure that this business model is going to work. For example, let's just say you're a highly regarded doctor and you're looking at a company that is working on a new drug. You've seen the research, you know the research is successful, so then you invest all your money because you know what nobody else knows, that this drug is going to work. Then yeah, then I would invest heavily. But besides that, would not invest a lot of capital into these companies because you really don't know. They're expected to fail. That is why they're so cheap. They're expected to fail. They're highly speculative. I would not go run and put all your money into it. And if you're day trading, you know, these are classified for beginners. They're not. They're where the pros play. There were a lot of big traders are going to play because there's that lack of institution, right? It's very hard for big companies to get in with big size time. Now there is hedge funds do trade these, right? Baker Brothers is a huge biotech company that trades biotech companies. They're very successful. I'm not saying there's no institutional buyers, but I'm just saying the primarily the ones that are going to be day trading them, those are all retail traders, right? Those are not going to be these big hedge funds. So before you trade them, this is very important. This website is free to use and it's going to save you a lot of time and effort. Use bamsec.com. There you can see all their filings. And this is really important because you can see all the news. You can see when their insiders bought or sold. It displays everything for you very nicely so you could really make better decisions, especially if it's a news trading catalyst. You can see that if the news was repeated and you can see if the news matters. Also, when I do trade small caps, which I'm just going to disclose right now, I really don't, I'm on the short side. I look for these really big extended moves that I know aren't real moves. They're just kind of like pump and dumps. And I look for shorting opportunities. Now, if you have a regular brokerage or commercial brokerage, you're not going to be able to do this. You need a DMA brokerage to be able to find locates for these shorts. All right, guys, that's everything. Just remember, if you're starting off trading, you really got to know what you're doing to get into these markets. Now, it might be appealing to you guys because you need low capital to make large returns. But if you put all your capital in and the stock moves 90% down, you're gonna lose everything. So you gotta be really, really careful with these small caps. And you really gotta know what you're doing. Like, this is a very active playground you're playing in with a lot of pros. You're probably not gonna make money if you're going up against a pro. So you gotta just know. You gotta know who you're playing against and you gotta know what you're doing. While it might seem appealing to you, you know, you gotta really outweigh the risk to reward ratio. Like what exactly are you playing with? Now, that's really it, guys. I hope you guys enjoyed that video. Please hit the subscribe button, and I'll catch you guys next time.
We can take it fast, so we can take it slow. I don't think I need to lie. Baby, come up in my ride. I just need you by my side. I'm getting money, but